Okay, good evening, everyone. If you can hear me as always, tell me which team you want to win the Super Bowl, whether they're even in contention or not. I want to know which team you would like to win the Super Bowl. The Pats. I'm kind of a Pats as well. All righty. Waiting for everything to come up. Should be looking good. All righty. I'd like to welcome everyone to the Hurley Investments Market View Commentary. It is Tuesday, January 22nd, 2019. If you have any questions, go to the question bar, type in what your questions are, off we go. Maud says the tennis championships. That would be interesting. I think Serena has a good chance and Djokovic has a good chance. Serena just knocked off the number one contender for her. Always good to know that you guys are paying attention to the world, right? Here we go. Tonight, I'm going to talk about what I call SMART goals. And I'm going to do this as a more of an education format. This was first published by Spread Trade Systems and I believe Seeking Alpha and the New York Stock Exchange. This was one of my first published, what do I call it? One of my first published articles, and it goes all the way back to 2011. I'm obviously going to change that to 2019. And we're going to do a couple updates. As a coach, I'm going to change that to as a registered investment advisor. I've heard two questions over and over and over again the last couple of weeks. And it's probably the last couple of months, ever since things started to head down in November. What do I think the markets will do in 2019? It's almost as if people gave up in November. I'm shocked to hear some of the losses. They gave up in November. The market will do what it'll do. Kind of one of my funny ones. Well, if it's God's will, I'm going to make money. A complete loss of accountability. A complete loss of doing anything when the markets went down other than they're just going to ride it out. And I'm going to talk about that next week. And then what are your goals for 2019? So I'm going to go back to, and I'm going to use a couple points here as I go through this and change it just a little bit. Both questions intertwined, and here's my 2 cents. I believe more people lose money in 2011. I'm going to change that to 2019. As they're set their primary goal to make everything they lost in, I think we're past the 2008, but I'm going to change that to 2018. And it's for all the same reasons. Ego loses people money just as easily as fear and greed. There are no guarantees in the market, and there's no proof that the market will bounce back next year. It would be great to make back everything you'd lost, but profit is still a profit. You don't go broke by taking profits. I also am going to say, and add another sentence in here, you don't go broke by collar trading. Now, yes, you can be down for a while. Being down in collar trading is good. It means you're making money up on puts. It means it's giving you the opportunity to add shares of stock. You're building a Buffett-style portfolio that works significantly better than dollar cost averaging, that works significantly better than riding out the ups and the downs, that will be significantly better than what a typical broker will do for you. Again, I'm going to come up with a website, hurleyacademy.com, and I'm going to start to post some of this out there for people to see, for people to use. I'm tired of seeing people get taken for really all they're worth. So we're going to get back to a little bit of this, but the short answer is it's okay to be down in your portfolio if and only if you have a process in place, a process that you can work through some of the hard times, a process that'll allow you to make up some of the downside movement and pick up more shares. That may mean in a smaller account, you can't play Apple, you can't play Baidu, Google, Disney, Visa. You might be stuck in single digit or less than $20 stocks. Kevin, why is that so necessary? Go back to last week. The key is to pick up more shares, to find a way to pick up those extra shares. I'm not going to lie to you. Last year was a tough year, but I look significantly better this year because of my ability to pick up more shares. I think after this earnings event, I will most likely be beating the market significantly. Reason why? Picking up shares of Disney at 85, 95, 100. Picking up shares at Visa at 125. Picking up shares at Apple and Baidu. Tons of shares of Ford. Shares of Under Armour, Marvel. All opportunities to add shares are the key to being able to beat the market, but it's a process. And that process is not based on my timetable. It's based on the timetable of the market. It was ridiculous. The first 2 weeks of December, the crap and BS I heard from people that were trading the market. I'm going to get a 20% this year. That's your goal. What else? Well, I'm going to get 20%. There's no material, no meat behind I'm going to get 20%, other I'm going to get 20%. As I had people talk with me, I was disgusted at what people were thinking, what they were going to do to make more money. Why don't you just pull that slot machine handle and good luck? Stupid, dumb. You don't go broke from taking profits. I think you need to take more profits this year. You don't go broke by collar trading. I would hate to see anyone in the market think they know more than the market does and try to outguess the market. It just doesn't make any sense at all to put on risky trades to make back what you've lost in a week, a month, or last year. Let me introduce you to the idea between being smart in your goal setting, because I have yet to hear a SMART goal in 22 days this year, or even going back to last November. I have not yet heard a SMART goal from an investor, from an educator, from a professional in the market. In fact, everything I've heard has been awfully damn stupid, and I'm shocked at how people think that's going to get them to where they need to be. The S in SMART stands for simple, specific, and a schedule. Now, it's in that order of importance. I like the acronym that I say, keep it simple, stupid. Set a simple step. The simple step, in my opinion, for most people should be work on doing your due diligence. I'm probably going to sell my due diligence in this coming year. Just because I'm doing the earnings reports, on the international economy for trends. Doesn't mean if someone else does it for you, you don't have to do it. Keep it simple. Start with the things that make a successful, and that normally starts out with do your damn homework. I'm sorry if I'm sitting here being so animate about some of the things that I'm hearing, but I know this is going to be heard by a couple other people that I want to hear what I'm going to tell them. But part of being simple is do your damn homework. Don't let someone else do it for you. Don't think it's not important. If you don't build a foundation built on hours of hard work and study, of understanding market trends and the way things are moving, how can you ever expect to truly be profitable on your own? Specific. You might have a lot of simple goals that'll get up to how you're going to get a 20% return. That specific has to count for things not working the way you want them to. That specific has to count for losses, for unfixable trades, for maybe pushing trades farther out in time. I had some week-long calls that did nothing last year on Bank of America. So with what I had left on them, I had a lot less contracts rolled out in time. I even added money. There was some point in time at certain people's accounts, I had 65 contracts of Bank of America. Today, I look pretty damn smart. I think damn is going to be my word of the day for the day. I'm really frustrated. I want to use some other ones, but I got to make this, I got to be smart in how I say this. I look awfully damn smart today. I did not look awfully damn smart last year. In fact, last year, I'll be honest with you, on a couple positions, I looked awfully damn stupid. My numbers were correct. My valuations were correct. My profitability in what I could have had was correct. It just didn't move on my timetable. So that's how I'm going to go to schedule. You do have to schedule it out on what you think it's going to be in time frame. But I want you to use your schedule is that on some type of daily basis, you are working the basics, the simple things that you need to do to get better if you're looking to get better. The M, measurable. You can't measure, I'm going to get a 20% return next year. That's a pinpoint goal. Let's go back to making it simple. The average is only 7.75%. In real life, if you make it so specific, a 20%, and by the end of February, you're so far away from it, what do? You give up. You quit. Or if you hit it, then what do? Well, some people quit. They're done for the year. Set a range goal. And really what I mean by a range goal is a goal that has a low end and a high end, a range that you can adjust it, or like a sliding scale, move it along. It's going to give you something to always shoot for. It's going to give you something to work on that really it's nothing more than an accountability or an accounting process. What can I do to work on meeting my goal? And really it's a bunch of those simple pinpoint goals all added up that's going to give you a range goal to get to where you need. Attainable. The attainable part is how are you going to make your plan to attain your goals? This is a step by asking yourself, what or who do you want to become? A better trader, a full-time trader, A stay-at-home dad, a millionaire. Maybe it's money that pushes you. Too many people at the start of the year write down a wish list, not a goal. And this is where I don't get it. I don't understand, and I worry about people. I want 20%. It's a wish list without all the effort and the work behind it. I wish the end of the year I could make this amount of money or lose this amount of weight. You can see where I'm going with that wish list, right? How will you do it? How will you get there? What specific steps are important? How much your portfolio will be safe in collar trades? How much will be pure option strategies? In fact, I want to go back to that. How much of your portfolio will be safe in collar trades? Last year, I had some positions that were down a couple, as much as 40%. Core positions, 3 or 4 positions, 2 out of 3, 2 out of 4 down 40%. I am proud to say I did not have clientele who were down 40%. That's part of being what's called a stock jockey. Thinking you're going to pick stocks that always outguess or outbeat the market. Yes, you do have to pick stocks, but if you're foolish enough to think you're a stock jockey and are going to ride all your stocks to ridiculous financial returns, you're an idiot. My stocks are protected with married puts, collar trades. A good growth portfolio, and where I'm going back to when I asked how much your portfolio will be safe in this amount of weight, here is a pretty standard growth portfolio. Conservative trades, perhaps 70% of your portfolio. Cash or T-bills. Understand, T-bills can lose money. If you're going into a bond of any kind, you have to be okay with that return over the life of the bond to get your coupon rate back. Collar trades, most of my portfolio will be 70% in collar trades and or protective puts, sometimes known as married puts. Insurance on stock ownership. Covered calls are not a protective strategy. Covered calls with long puts or deep in the money. Meaning, last year I ran some Visa positions with 105 and 110, 15 to 20% in the money covered calls. That is a smart strategy. That is a protective strategy. And obviously having 70% of your portfolio in equities means you have for forever to have them come back. Medium risk are spread trades. I put a bunch of them in there. Just thoughts on taking a little bit of money to leverage profitability. And then the high risk trades, directional long calls or long puts, naked short puts. In fact, I should write that in there. Naked short puts, naked short calls. And I'm going to go ahead and write this. Never do this unless you are willing to risk and lose everything. And just a thought process behind this. I had someone that I really consider a friend, an amazing guy, one of my original people that invested with me. To protect the name of the innocent, I'm going to call him Batman. And Batman told me, hey, what do you think of Mosaic? And there's some risk in there. There's actually some pretty good risk in Mosaic and Intel, where they just might not turn out to be what you want them to be. So, plain and simple, he said, I think I'm okay owning Mosaic. No, Altria. It's Altria. Excuse me. M.O. Not Mosaic. Altria. Let's get Altria. M.O. And he said, I think I'm okay owning Altria Group at 41.50 because there's 38 cents of risk. Well, guess what? If it's trading at 45, 44.91, I would be okay owning Altria at 41.50 as well. I did find it rather interesting. We are just getting into an oversold, so technically he could have told me, hey, it's just about oversold. Hey, we got a pivot point where things should change right around 41.57. Institutions have oversold it. We're looking for a bounce. If those comments were made to me, I would better understand the need for a short put. But to be told I'm willing to own Altria at a short put price in that 41.50 range is not a smart thing to say. It is when it's trading at 44.98. What if it's trading at 35? Would you be okay owning a stock at 35? Would you be willing to own the stock at 30 if it was trading at 41.50? Would you be willing to own the stock at 25 if you had to purchase it at 41.50? Pretty interesting because I'm not giving him enough credit. I know he probably studied it. In fact, I'm seeing a couple things come in. I'm not giving him enough credit. But more often than not, I hear that comment, and the comment makes me think, well, of course I'd be willing to own at this price. But what if it went down to this price? Of course I'd want to own it at a cheaper price when it's trading higher. And it's interesting because as I wrote my email back, it's all about the risk. And really for short puts, it's all about how will you manage the risk until it doesn't work the way you want it to. I've been in and out of Google L, and I've been in and out of it on a pretty continuous basis at 100 and 160 shorts. Well, I got hosed on my bull put because it went down to 994. Had to roll the whole thing out in time, and to get more credit, I had to go out to 1080. And then I'm making great money on it, but I'm trying to make up for a client that lost 9,800. I had almost $5,000 profit one big down day. Last week, before options expiration, I took $3,200 of profit. If I had held on to it, I could have made $7,000. But it's all about controlling the risk. And it's interesting because I'm really pushing this not for the individual that sent me the email, but for the individual I spoke with at 5 o'clock today. At 5 o'clock today, the question was asked, would I be willing to own Apple at 150? And there's a pretty good short put credit. So, guess what? I would be more than willing to own Apple at 150 when it's trading at 157. I'm not so willing to own Apple at 153. At 150. And for Superman that's out there, I sure as hell don't want to own Apple at 150 when it's trading at 142. And the scary thought is, I really don't want to own Apple at 150 if it's trading at 135, 120 to 122-ish, or 100. So again, to protect the names of the innocent, I'm going to ask Superman. Really? A naked short put on Apple of maybe 15 to 20 contracts on less than $100,000 portfolio? There's nothing really super about that. That is ridiculous amounts of risk for not enough return. And I know you disagree with me. So let me give you one more story. Kevin, have you ever taken 50,000 to 650,000 over a 2-year period? No, I have not. Well, Kevin, I do it every weekend. I put it on 15 minutes before the market ends. Naked short puts on Baidu. Take it off on Monday. I cash in over time decay. My probabilities are this or that. I've taken $250,000 on naked short calls and turned into 650. Pretty impressive. I still remember the day he told me, you know what, Kevin? You suck. You shouldn't teach. You shouldn't manage money. You shouldn't even be in the market. You suck. And I smiled as politely as I could, and I said, okay, I will not talk to you later. Good luck. And it was about 2.5 months later, guess what happened? Google left. Was it Google? It was Google left China. And all of a sudden, Baidu jumped $120 over the weekend. Guess what? I was ecstatic. I have ridden Baidu from 135 to, I'm pretty sure it was 750 or 775 and a 10-for-1 split back down. And the call I got, as pissed off as I was about it, was heartbreaking. Heartbreaking. Bill, you're 100% correct. Kevin, what do I do? Well, Jay, you're pretty much screwed. I can't. There's got to be a way to get it out. There's got to be a way to fix it. $650,000 down to 46 overnight, losing more as it continued to go up. Well, you can exit your positions. I can't lose that much money. Well, you already did. $600,000 evaporated over a weekend. It cost him a home. It cost him a divorce. It cost him a job. It destroyed what he was doing. Changed his whole life. You got to look at what you're doing. The comment was just made, 100% correct. And please don't think, well, there's Superman here tonight. I am saying this for you because I knew you were going to listen. But there was a comment made, very important. It's one thing to be risking your own account, but being responsible for managing someone else's account is another thing. 100% agree. Bill, that's 100% correct. You just got to be smart. Figure out the details on how you're going to get to where you want to be at. Start with the end of the year goal on December 31st and walk yourself backwards. As you're doing your goals, they are realistic. I always want to make a 50% return or more. I'll be honest. I've got a couple slush fund accounts that I've done some really stupid things in. Some years like this past year, I wasn't quite close to being at that goal. That's what happens in real life. We're nowhere close to our goal. We'll quit. Do we give up on the whole thing because we never hit our goal? Or do we use step-by-step progression and finding and trading is fine if you make sure your goals remain relevant throughout the whole year, throughout possibly your whole lifetime. Don't forget, goals can be adjusted like a trade that may go south. And then it comes down to time. The neat thing about trading, the more time that you have, the more leeway you have given yourself. Set your time period that you can set your realistic goals. Set short-term energy that you can reach and that are attainable. Here's the big one. Let others know the time period you expect to reach your goals and get the support needed to get there. Whether it is between you and your spouse, your kids, your parents, your educational program. For me, I'm going to say Bill. Bill talks to me so often. I use his psych profile to help me out. I use Jeffrey. I use Keeve. Keeve is a big help to kind of bounce ideas off each other. Your parents' education program, maybe the good Lord himself, find support during the tough times. I promise you they will come. If this was easy, everyone would be doing it. When you start to see the ridiculous garbage that's out there, how someone's making 95 out of 100 trades correctly and they've got hundreds or thousands of percent returns, real easy to do with a $5,000 portfolio and get one trade right. Real easy to do when there's no real money involved. It's a paper trade. Real easy to do when you're not doing it for reals, when you can back test and change your results. Be okay with your results. And if you need help, the most important part is finding someone that's going to hold integrity, that will tell you the way it is, that will tell you in the bad times, maybe not doing as good as I could. Maybe I need to change or adjust what I'm doing to make things work better. Be willing to talk to someone that has 99% of the answers, not all 100. Because if you had all 100, Goldman Sachs would like to buy you out for trillions of dollars. I'm actually going to get rid of that part. A couple new positions I'm looking at this year. Walmart's on my list. Alaska Airlines. I keep seeing First Solar pop up. I like Energy Transfer. Microsoft could be one that's interesting for me. Excuse me. That's waste management. I am looking at Walmart. Thank you, Abraham. My favorites, my core positions. Apple, Baidu, Zion, Disney, Ford, Visa. I'm going to put Under Armour out there as my wild card. I'm not looking at Berkshire Hathaway B shares at all, Abraham. Sorry. I'm also looking at, for smaller accounts, following the SPY, the Qs, possibly the diamonds. If you ask me where our market's going to end from here on out, I'm going to tell you higher. As I look at charts, I do feel okay right now with what's happening. Keeve and I sat there and talked to each other, and we're trying to find out where we thought we'd be. But pretty interesting. All I see is a little bit of profit taking, and I'm grateful that the 50-day still held. We are still bullish on the Dow. And our big drop today, I think 50% of it can be attributed to some pretty poor earnings. I think 50% of it can be attributed to a false rumor that meetings were canceled for China. That the economic advisor, who is his name? The old guy. Oh, I can't remember his name. CNBC guy. That said there was no truth to the rumors that a scheduled meeting was canceled. Because of that, and it's Kudlow. Thank you very much. Kudlow put 250 points back on the board for me today that we will most likely gain back because our market was moved by a rumor. Pretty scary to see that a stock market can literally be moved by a rumor. Not only that, but it looks like some stock markets in Asia slid a little bit due to those rumors. And I would have thought our stock market would have been up higher on the earnings after hours. Nice to see some pretty big beats. Citigroup, though, did kind of blew it on their earnings. But Dow Jones bullish, held the 50-day. I think we'll gain 250 points back tomorrow. Comment was asked, do you collar on liquid ETFs? I do not. I'm really collaring for the big pops. And we don't see the big pops or moves on the indexes or the ETFs. And you guys, I don't think, see each other's questions. So let me answer this one. Superman, everybody's risk tolerance is different. So if you want to go big, go big. But don't think you can be a Superman against the stock market. And that's where I was going on this. I'm sorry if you feel it's offensive. I'm not saying your name. In fact, there was another person that had a similar question on the short puts versus the short calls. I was trying to use the short puts so you wouldn't feel attacked or attacked. But in my opinion, a naked short call has unlimited risk, and I don't think that's justifiable in any portfolio. So with all due respect, yes, people have different risk tolerances, and I'm sorry, I don't call limited risk a risk tolerance. I call it a stupid gamble. And with all due respect, I hope you'll still talk to me and come, but the short answer is, if you're looking to gamble, you obviously haven't paid enough attention, nor do you know much about Apple. You should know that pretty easily Apple will go through its earnings and it'll go right back down to its lows. Historically, that's the pattern for Apple. With all due respect, if you think naked short calls or unlimited risk are the way to trade your portfolio, you're gambling. You have 50-50 odds. Really probably closer to third 66. That's not what I'm about. That's not what you should be about, because I know you can't afford it. So if you're ready to do naked short calls, this is not the place for you to be. I won't give you an okay and say, yeah, that's smart. In all honesty, it's a pretty damn stupid way to run your portfolio. Don't do it. All right, off the daddy soapbox there. Let's go to the S&P 500. Boy, that kind of takes the stuffing out of you, and there you go. Oh, well. S&P still held the 50-day. We are still bullish. Obviously, with the better earnings that came up, we'll probably have a run. But if you'll notice down there on the Williams percent R, this is where on the S&P 500, I pay a lot of attention. At the Williams percent R, you do not hang out overbought for a long period of time. Institutions don't do that. They've got their algorithms and their programs. So tomorrow will be a telling day. Tomorrow will be a very telling day in regards to really in regards if we're going to hold on to 2,600. If we'll hold on to the 50-day. I think we will, but expect maybe some muted days until we get into some bigger headlines for earnings events. And last but not least, here we go. Let's go to the NASDAQ. NASDAQ probably is going to look like the rest of it. There it is. Get in there. Still bullish. Horrendous 2% pull, 1.5% pullback. Not only did we hold the RSI median line, but we bounced off almost to the penny on the 50-day simple moving average. So technically speaking, we're looking okay. And a comment just made, it might fall a bit, but the trend higher, crystal ball. The short-term trend, in all honesty, we've broken out of, and it's going to look horrible, we've broken out of, just barely, our trend line. And in all reality, more importantly, the new trend line is a pretty tight one, looking more like that. So I think our new trend will be up to the 200-day simple moving average. And then we're going to run through maybe a quarter of stagnation to see if we can hold some things. The big push between the 50 and the 200, it'll be nothing more than China, I bet. I don't think earnings will push us higher. I don't think upgrades will push us higher. Take a look at Under Armour today. I think it will have to be a China trade that comes to pass so that we get a world market growth pattern versus just a single stock. All right, here we go. Moving on. I am still calling for a 2% upside in January. I know we're probably up right now, what, 4? I'm not so sure it's going to hold. But with that said, I do like the fact that Zions Bank couldn't hold any of its gains after its positive earnings. What a bummer. So what I was going to say doesn't matter. But I do not think we'll hold the whole 4% like we did last year. I think we'll be lucky for a 2, maybe a 2.5%. Earnings, first full week of really going to town. This is where we have big earnings. Zions Bank was one, and IBM was one for me today. Nice to see IBM talk more about their Red Hat trade. I will not need to protect Red Hat through their earnings, as they will be devoured by IBM, and IBM actually beat their earnings, top and bottom line, beat their fiscal 2019 yearly projections, yet they are coming in with lower revenue year over year. So that could hold them back, but IBM still looked pretty good going into after hours trading. We have Wednesday Ford, which I'll pay specific attention to. I think Thursday is Intuitive Surgical, but I will be paying attention to Intel on Thursday. And what else do I have? Looking at my planner, FCX, Freeport McMoran, I'll be paying specific attention to on Thursday. We'll be in Houston on Thursday. Wednesday will be a travel day for me. DH Horton, I'll be paying specific attention to on Friday, seeing if there is a bounce in the step of the home builders. I've put all of our economic reports out, but obviously home sales won't come through. Durable goods and new home sales on Friday won't come through. So even though these are the economic reports that are listed, it does not mean that they're all going to be coming through. For home sales, new home sales, home sale prices, you're probably going to watch the FHFA housing price index will take precedence, so those other two are not being given. Internationally, World Economic Forum, Davos is there. The Euro will do their business climate and consumer confidence, which will affect Brexit tomorrow. How am I looking to trade? I'm only doing protective puts and no short calls. I'm going to do short calls after the fact if I have to. Too many of what I've traded has too much upside potential to it that I don't want to cap anything at this time. I'll cap it after an earnings event, knowing that there's huge upside potential. Asian stocks were higher yesterday as China says the economic grew in line with expectations last year. Even though it was as low as the slowest pace since 1990, China did grow supposedly, take it with a grain of salt, 6.6% in 2018. Have a pretty interesting article on the outsized return potential in 2019 on Ford. All of these numbers are correct, and most of these numbers have been correct since 5 years ago. So, once again, if you want to see what people like me see in Ford, here is the guts. This is the guts on why people like Ford. Really, it comes down to being able to understand where their where the risk to reward is on their credit or their debt. They have rolling debt as they finance the cars themselves. In all honesty, most of that rolling debt gets cut off as it's refinanced 6 months later, because if you hold on to their financing for 6 months, you get some extra incentives when you buy a Ford car. After that time period, you normally go refinance through somewhere else, and they're off the hook. Shares are selling for just 5.3 next year's earnings estimates, making the company ridiculously cheap. Ridiculously cheap. Freeport McMoran, as I said, I've got some positions in there. It was brought over to me by a couple people, and I've kind of fallen in love with it myself. I fall in love with it because I've been able to get in that 20s and the $12 range, not necessarily at a $40 to $50 range. But if you're looking at a world growth, if you're looking at gold, which is just topped out at 1,300. If you're looking at copper or metals in general, a very interesting article that as I went through and I calculated some of their calculations in here, I like it. I like it a lot. They're just focusing primarily on copper, but there's more to it than copper for their major assets. It all makes sense. It all makes sense. I like where they're at. I like where they can get to. Intel. I was talking to an Intel position that I like the week I put it on for. And since then, I've hated every single look at it since. Intel is a risk. It is a risk. The short answer, if they do announce a new CEO, sell it on the news. Take the pop, sell it. They are going to be a work in progress. Another, what I did with my Intel shares, pretty interesting. I wouldn't spend too much time on it, but I did like the way that he talked about protection. We'll get some of this useless stuff out of here. Pretty interesting. Actually, why did I put this in here? There was a reason. I since have forgotten it. Pretty interesting article on DC Gridlock on Larry Glazer on how it's good for the market. And then kudos to one of my clients. I was reading a Disney article as I noticed the email that came across. Pretty neat when you're both reading the same thing. I am expecting to take off current short calls on Disney just because as I'm working my numbers, there's too much upside potential. I can put them back on after earnings, but boy, these guys did a great job of describing the upside opportunity on Disney like I haven't been able to. With that said, I think I'm running a little bit late tonight. What questions do you guys have? What questions can I answer? Obviously, there's going to be no shortage in me telling you exactly what I think. Please don't let that scare you. Please don't let you think that I don't like you. I just don't want to see people get their butts handed to them for doing stupid things. And for those that were here earlier, for my short put example, I was trying to use that to help out Superman, and he didn't listen. Big difference between a short put and a short call, especially when it's naked. All right. Well, hey, I don't see anything coming in. Oh, Kevin, is there anything new you're going to add to your positions for an earnings season? I pretty much added everything that I'm going to add. In fact, I probably should really come up here. Most of my portfolio is sitting in this right here. But as I came up here and I talked about what I'm looking at, I really should add in here that I have a substantial Bank of America. Keith, what else have I missed that's maybe some core positions? I do have Zions Bank, but it's not a core position. It's kind of an outlier. Facebook is an outlier. FCX is an outlier. Intel, Red Hat, Under Armour. Yeah, I think those are my my core positions: Apple, Biden, Bank of America, Zions Bank, Disney, Ford, Visa, and Under Armour. Those are the core positions. I do have other stocks that are on my watch list, but those are kind of outliers. That's not something I'd look to say, hey, my small guys, my middle guys, and big guys are all going to have these. These are things that were brought over to me that I just kind of have in there that I've agreed with. And I thought it looked pretty good. So back to the question. I wouldn't add anything particularly to this earnings that stands out to me. I would stay away from airlines, home builders. I don't know why airlines aren't doing better because the energy is. Oh, and I'd stay away from gas and oil. Too cheap. You can't see how you're going to make a lot of money. Interesting question. What do you disagree with education's version of callers? Plain and simple, two things. Sometimes you see education come about that pushes caller trades because it's a smart trade. It's a really smart trade. But the biggest problem is they're trying to teach it to you for safety. And when you hear that you need to be collared and protected all the time, if you're protected all the time with just protective puts, you've got about a 28% growth that has to occur to pay for that protection. If you're rolling that protection up, you're probably overpaying for protection because your stock's not moving enough. And if you're adding short calls, you've now capped yourself when you need your stock to have at least about a 16.8% return till it can be profitable. So I do think collar trading is great. If you're not willing to make any money, you're always protected so you can add more shares. There will come a time when you have to use technical analysis and allow your stocks to run through some bullish trends. That's where you're going to capture or cap yourself after you've had your run, after you've made a good return. So when it comes to educations, it's great in theory to always be protected. It's just too expensive. You're overpaying for protection. And if your stock does not move at least 28%, then you're in trouble. And if you're capping yourself, it has to run 16.8%, but not over your short calls, because then you're adding more debit to your trade as you roll it out and up, trying to get a break even, usually having to pay a little extra to do so. So good question. That's my comment there. Again, really different to teach in theory and to trade in real life. Significantly different outcomes and different returns. Are there any other questions I can answer for you guys? Again, I do apologize. Got a little passionate there. Guys, it's just real life. It's just real life. Guys, have a wonderful evening. I will get this up posted later on tonight. Hopefully you'll be able to pick it up right away. I do look forward to starting my new program, but my new program where I'm going to do this 3 times a week at the rate the government's going will probably not come out till February. So thank you, Bill. So in February, you're going to start touching me more often as I'm going to be out doing more of an educational program to help people out. Guys, I appreciate you being here today. Hopefully you got something out of this. Hopefully it was important to you. And hopefully you'll take it to heart and use it where you need to. Have a wonderful evening, and I look forward to talking to you next week. Bye-bye.